Mai, haere mai, morena and welcome. Happy Friday to you all. For those of you who don't know me, my name is Trish Oakley and I come to you from the lovely Dunedin where I work for Forsyth Barr, heading up the Summer KiwiSaver scheme. Welcome to today's FSC Connect, where we have an expert panel lined up to talk you through the Financial Services Council's latest Financial Resilience Index. The Financial Services Council started tracking the financial confidence and wellbeing of New Zealanders in March 2020. So way back then, and what that means when we think about it is that we have some fantastic ground zero data because that was just before COVID had hit. The team at the FSC have continued to track this ever since, and the latest survey represents a sample of 2,000 Kiwis sampled in late January 22. Today, what we're going to do is see this research, which is the fourth edition of what we affectionately call FRI. Now, 4 editions don't just happen, and I'd like to take this opportunity to recognise my hardworking colleagues on the committee. So firstly, to my co-chair, Hamish Galloway from A&P. Thanks, Hamish, you're a fantastic person to work with. On the committee, we also have Chad Twist, Jeff Rimmer, Mark Benankovich, Murray Harris, Nadine Soul, Rachel Lim, Simon Tohill, Angela Tai, Lance Walker, and Miles Allen. I want to thank you for your stunning engagement in every meeting that we have. And of course, we have the fabulous Carissa Hurst and David Bishop within the FS team pulling us all together and making these reports a reality. Once we have that reality, it is, of course, about bringing this content to the market and yourselves. And I'd like to acknowledge the team at Trustees Executors for being our long-standing partner on the research generally and specifically coming on board with our FRI research. And today on the panel, I'm delighted that we've got their CEO, Ryan Bessemer, who I'll shortly introduce, and we want to thank and acknowledge them for their support. Before we get underway today, there is a little bit of housekeeping. You are, of course, entered on mute, but that doesn't mean that we don't value your insights and your perspectives. So please do use the chat function to enter any questions that you may have, and the panel are going to look and monitor that and incorporate that into the conversation that we have. So with the housekeeping done, let's launch in and take a look at what the research has to say. And there's some pretty interesting numbers in there for us to talk to. Some of the headline data points are 68% of respondents say they're worried about house prices, 65% are worried about interest rates, 79% are concerned about inflation, and 43% are not confident in the New Zealand economy. There's quite a lot to unpack there, and to expertly guide us through that whole report, I'm going to hand over to our FSC CEO, Richard Clippen. But before I do so, he's known to you all, and so can we just take a moment to acknowledge how fortunate we are to have someone with Richard's passion and energy for our sector, driving conversations with regulators, with the media and stakeholders generally. Now, all of that, of course, is to deliver on the FSC's vision, which is to grow the financial confidence and wellbeing of New Zealanders. And that's a vision that's worthy indeed. So whether we're standing behind our desks in the office or working from home, I'm sure it aligns to our own personal philosophies. So Richard, over to you. Please take us through the latest FRI.
Kia ora, Trish, and very good morning, everyone. And thank you for your very kind words, Trish. And folks, welcome to Friday, start of autumn. Look, the reason why we started this journey on FRI was to Trish's point around, our purpose is around helping New Zealanders with their financial confidence and well-being. But we actually wanted to do temperature checks and regular temperature checks on how New Zealanders were thinking and feeling, and not only about money, but about things like property, about things like their jobs, about their overall well-being, about their connection between money and how they were living their lives. And what we've uncovered over the last couple of years is that, the conversation about money is about money, but it's actually not about money. It's about you. It's about the people that we serve, about the kind of lives that they want to lead, the goals they want to have. And that's come through really, really strongly in this data, and it has again today. I'm just going to give you a quick run through because I think that this panel today is absolutely fantastic, and I think them unpacking some of the themes is going to be much more valuable. This document, the media release, is available on the FSC website, so commend you to read it in a little bit more detail. The FRI index basically picks up 5 key indicators, so financial confidence, financial literacy, financial preparedness, job security, and overall well-being. I'm only going to pick up on a couple of them, and I'll only make some just broad comments on each of them. So this is a key indicator one on overall financial confidence. And, we've now over 2 years through the pandemic. And when we started tracking this data, you can kind of see in the blue bar some of the anxiety and the uncertainty where people were sitting around decisions they were making. And, we had some pretty prompt government action around funding, wage support and so on, which really carried the country through 20 and 21 at a general level. And in fact, there are some sectors who've done it just amazingly tough and immensely tough. Tourism and hospo has really, really done it tough. Other sectors have done it really, really strongly. You look at milk prices at the moment, for example. So, we're seeing this track through some of the data. And so the overall sector on overall financial confidence, if you look over the last period, which is the green bar, there's a rise in overall confidence. I'm extremely confident, I'm very confident, I'm reasonably confident. Those three numbers together kind of in aggregate give us a pretty good sense of where people are sitting. And this is really the headwinds slide, and we were talking yesterday, it feels like there's a sea change and a step change going on. So for 2 years, we've had very intense pandemic environment, but relatively benign economic environment, full employment, low interest rates, booming asset prices. But that's starting to change. And what we're seeing coming through the data is around how confident are you about the direction of the New Zealand economy? That's starting to shift. Obviously, how concerned are you about things like inflation, house prices, interest rates? Trish gave you some of that data up front, but you can see it in front of you. Those are really starting to track through. So you can start to see, for all of us as households, when you pull into the petrol pump, it's costing us way more. When you're buying fruit and veggies, it's costing us way more. When you're looking to buy houses, it's costing us way more. So that underlying anxiety is definitely playing through this data. And, clearly one for all of us to watch, and certainly for all of us in the sector, because we face into the New Zealand community so closely, will be one for us to help unpack and to support people make wise and sensible decisions. Anything from how much debt should you take on through to which investment option should you be in KiwiSaver, through to should I switch now or should I hold the line? So this is job security. As you'd expect, this data is really strong. Unemployment is at record lows. There are more jobs than there are people to fill them. So people are feeling very secure and very comfortable employment-wise. And, we're going to have in the panel conversation a lot of discussion unpacking that with the so-called great movement and resignation. But, the data plays out pretty much as you would expect. And I'll close on this. So this is the overall well-being idea, the notion that it's not just about money. So, we ask things like, how often do you worry about money, daily, weekly, monthly, a few times a year? You can see that data. When you have money anxieties and money worries in your life, it impacts your physical health, it impacts your mental health, it impacts your relationships. And you can see in the hands, the extreme right of the three hands, which is the overall well-being. What kind of impact has financial issues ever adversely affected your overall well-being? And you can still see, even today, over 52% of people are impacted by money worries. And I think that is the underlying issue for all of us in the sector. It's the underlying reason why we all need to spend time on financial literacy and education, empowering people to get better with the way they think about and manage their money. And I think all of these things play in really well. So I'm going to leave it at that, folks. Suffice to say that we've been tracking this data now over the last 2 years. We're going to continue to track it. There's a lot more data to come. We've got some really interesting other research to come on this. Endorsed Trish's comments, wanted to acknowledge and thank the TE team for their support. But this is all ultimately about shining a light in the New Zealand community about the things that really matter, and for us as a sector to then take steps to help and support and to help and to work with people through that. And on that note, Trish, I'm going to hand back to you and to your panel. Thank you.
Thanks very much, Richard. And we've got a fantastic panel lined up to speak with us today and unpack us what unpack what we've seen on the screens. So to get us underway, what I'm going to do is ask each person to briefly introduce themselves, tell us a little bit about their role, and also perhaps highlight a key finding from their perspective in relation to the Resilience Index. So Ryan, I'd like to start with you, and perhaps I could also just ask you to briefly comment on why TE considers this such important work and partners with us on it. Ryan.
Wonderful. Thanks very much, Trish. We're very happy to be sponsoring the Financial Resilience Index this year. And as many of you know, we've, for a number of years now, we've had a real focus in sponsoring the Money on End Use series through the FSC. For TE, it's enormously important for us in a number of our different roles as an organisation, but particularly as a supervisor, to make sure that everyday Kiwis are being taken care of when it comes to their investments and overall financial well-being. So being able to be here today and do this is important for us to be able to show our support for the consumers out there. This in particular, coming out of the back of the pandemic, I think is a really useful look at what sort of real concerns are out there with everyday Kiwis, issues around cost of living, accommodation, rent, or access to property, what's happening with looming inflation. So, really for me, I mean, it's about how we protect Kiwis through financial education and through access to real advice. Some of the key indicators here for me, I don't think it's really surprising that there's a lot of uncertainty around what's coming out of the back of the pandemic. And really, I think you'll see as we look through the figures, there's this concern for me really around those people who've done well out of the pandemic because of because of parts of the economy booming, but then there's those people who've been adversely affected, and there's that sort of rising gap. So I think it'll be a good discussion today as we sort of break through some of these figures.
I'm sure it will, Ryan. Thank you very much. Morena, Vicki, welcome. It's great to have you on the panel. Tell us a little bit about yourself and your role and what stood out for you.
Thank you, Trish, and good morning, everybody. Vicki Caisley, I'm the Chief People and Strategy Officer at Southern Cross Health Insurance, and a bit about my role. So obviously people, so look after our workforce as well as our strategy execution and strategy development functions. So very privileged to be working for Southern Cross and caring for our 900,000 members that we look after. I think what stood out for me in the report, and actually speaking from a Southern Cross perspective, that in terms of what we see coming through our data, the trends in the fry around connection between financial issues and overall wellbeing are really consistent with what our employees tell us through our annual internal wellbeing survey. And also our aggregated reporting that we get from RAISE, which is our employee assistance provider. So the top contributors to stress for our people are typically external to work. They are financial concerns, number one, relationships and family issues, which is absolutely consistent with what Richard was introducing at the beginning, talking about this report, and that if you're not feeling, if you have financial concerns, it's going to flow on to other areas in your life. Our data is mid-2021 that's telling us this, and so I expect that those concerns are going to only worsen at the moment, given what we're seeing in the fry.
Thanks very much, Vicki. I look forward to coming back to you when we discuss some of these themes. Jarrod, welcome. Great to have you with us. Tell us a little bit about yourself and your thoughts.
Kia ora, everybody. Ko tāne wita waka ko Ngāti Mani Poto me Ngāti Mahuta iwi ko Jarrod Haar tuko ingoa. I'm a professor of human resource management at UT. I've been doing studies on the workforce across the pandemic. So I'll make some comments about mental health and job insecurity in particular. But I guess one of my key findings from the report was that interlink between well-being and financial wellness, or the opposite, right? If we've got financial stress, was over half half the respondents were saying it impacts on their well-being. And I think that's a useful way to think about, some of the drivers that I'll talk about a bit later about well-being and insecurity. So fascinating stuff. Kia ora.
Kia ora, Jarrod. Thank you. Mary Jo, good morning. Welcome to the panel. Your thoughts?
Kia ora. Thanks for having me on the panel. I'm an economist. My name is Mary Jo. I'm an economist at Kiwibank. I think the main takeaway for me from the report was just seeing how the high proportion of respondents feeling pretty downbeat about the economy. Bear in mind that this survey was taken prior to the Omicron outbreak, so I'd imagine if you were to run it again today, it may be an even bleaker assessment. But the economy, it's facing a lot of headwinds, so concern over how the next 6 to 12 months ahead will pan out, I think is only warranted. This year, as Richard said, will be very different from the past two. Our economic recovery has been surprisingly strong, and inflation is now a very big concern. So much so that our central bank has pivoted its stance on monetary policy and is now working on slowing economic activity, and much sooner than they had initially anticipated. So we're having to navigate ourselves in a rising interest rate environment, and it's been a while since we've had to.
Thanks, Mary Jo. I look forward to coming back and drawing out your insights in a few moments. But Adam, welcome. Happy Friday.
Yeah, thanks very much, Trish. So, hi, everyone. Adam Boyd. I'm part of the executive team at ASB, and part of my role has been sort of supporting the work that the bank's been doing and I guess in support of our purpose. So our purpose is all about accelerating financial progress for all New Zealanders. And one of the ways we've been going about that is through the development of a financial wellbeing index and then building out all of the tools and resources to support that. So there's a huge parallel with sort of what we're going to be talking about today. So super excited to be here and part of this conversation. I think one of the takeaways for me out of the survey was that, I think, despite all of the challenges that we have and are experiencing, I think one of the positives that we're seeing is that there are improvements going on in financial wellbeing, and you can see that in this report as well. So for those saying that financial issues are adversely impacting their wellbeing, whilst it's still high and too high, it is actually reducing. And we're seeing that in our own data as well, primarily as a result of customers building savings balances. And so I guess perhaps ironically, over the last 2 years, we have seen financial wellbeing actually increasing through these challenging times. So I think just an example of a positive that is going to hopefully continue to come out of this environment.
Thanks very much, Adam, and everyone for your introductory comments. I'd like to start. I'm going to open the conversation with you, Adam, and I just want to look at the horrific situation that's unfolding with the Ukraine invasion. And we entered 2022 with already a lot of volatility in markets. The invasion saw the NZX year drop to a 2-year low. It then bounced back a little bit a couple of days later. So we've got a lot of action there. We've got the uncertainty of COVID. All these things come together. How do you think this invasion might play out in terms of the data in these stats? What might it deliver if we went and sampled again today?
That's a very interesting question, Trish, and I echo your comments. And I think the environment over the last 2 years has been highly uncertain. And I think Richard might have mentioned this in his press release. The events in Europe are only likely to continue to create even higher levels of volatility and higher levels of uncertainty. And so I think, in the context of the survey results, I think it would be natural to expect to see higher levels of worry, higher levels of concern and anxiety, particularly around perhaps those areas such as job security. I think equally, as I sort of mentioned as I opened it, on the flip side, I think we're probably going to continue to see those trends of improved resilience as customers continue to try and, I guess, put more aside for those rainy days, those uncertain periods. So I wouldn't be at all surprised if we were to see sort of financial resilience improving at the same time as anxiety and uncertainty was increasing.
Thanks, Adam. Mary Jo, from an economist perspective, how are you seeing this unfolding?
Yeah, it was pretty fascinating watching how financial markets reacted to the invasion. And initially we had those classic risk-off moves with equities lower, a flight to safety to safe haven assets, and we saw a New Zealand dollar it remained relatively stable, which was quite interesting. But then once those sanctions came onto Russia, there were fears that it would start to disrupt supply. And so what we've seen over the past week even is just commodity prices have just rallied in response. Brent crude oil is up 20% since the beginning of February, and it's breached $120 per barrel. That's the first time since 2012. Wheat prices have jumped to their highest since 2008. European natural gas futures have also rallied almost 40%. So we're seeing this commodity price rally. So what that does, we'll feel the flow on in terms of higher imported inflation. That only deteriorates our inflation outlook and only kind of, I guess, more concerned about how this will play out in terms of inflation. But financial markets are typically myopic. They see what's right in front of them. But usually these invasions and these sort of war plays are sort of a temporary event. It's hard to say when it will end, but in terms of what we're seeing in the markets, it's very, I guess, a current play. It just depends on how this will flow out into our inflation outlook.
Thanks very much, Mary. We'll come back to inflation in just a moment, but it would be remiss if we didn't look at this from a client care perspective. Ryan, do you have any comments about the importance of maintaining communication with investors at such times?
Absolutely. Joe, for me, I suppose I look at it fairly basically, and I put myself in the place of an investor. We, Joe, as an industry, financial services industry, I think we have more of a duty to be able to give access to good products and services. But that being said, we need to be able to probably disclose what those products and services will do, particularly with markets moving and so on and so forth. I mean, the everyday investor doesn't necessarily understand what it is they're buying, and this is a case of financial literacy, absolutely. Unfortunately, the stats show that financial literacy is going down. It's also a sake of education, and that education should be happening in school and in home, but it also in the workplace. But it also needs to be happening from the financial services industry itself, educating consumers on what you do. I mean, you go to the pharmacy and you'd buy a vitamin and it says, this is good for sleep, or it's good for muscle movement or whatever else. I mean, we don't put those types of things on the labels of our financial products. And maybe we should. So I think to be able to move forward, we need to be able to make financial products understandable, because obviously we've got inflation happening. Mortgages are at an all-time high. What's the impact that's going to have in the future? Are you financially prepared for that? Are you putting away savings? If you're going to be putting away savings, where do you put that money? How do you invest it correctly? This leads to sort of overall financial well-being, but as Jarrod was saying, it also leads to overall well-being for an individual. So I think there's still a lot to be done there in that space around consumer protection, financial literacy, and education.
Thanks, Ryan. I think we'll come back to that as a topic a little bit further on, but I just want to go to you, Mary, with regards to inflation in the economy. And as we noted in the data, 79% of respondents are concerned about inflation and 43% are not confident in the New Zealand economy. So should people be concerned? What are we going to see? What do people need to be thinking about? Your thoughts?
Yeah, well, with inflation running at 6%, I think it's only natural that many are concerned about it. 6% is a 30-year high. For the better part of the past decade, inflation's been pretty much dormant. Central banks have actually struggled to get inflation back to that 2% target. yes, it's true that a lot of the spike in inflation has been propped up by global forces, the fact that demand is, growing as other economies reopen. But for a few quarters now, we've seen price gains across the board. So it's not just those most affected by disrupted supply chains. I guess what's happening here is that our economy is running above potential, where demand is outstripping supply. So across the economy, sectors are bumping up against their capacity constraints, and that's a major driver of inflation. So what we're seeing is that even if you remove volatility in food and energy prices, core inflation is also lifted to 3-decade highs. Now, I should say that high inflation is not necessarily a bad thing. In fact, it's a signal of a growing, healthy economy, but it's high inflation for a long period of time that's what we don't want. And the threat of persistent inflation is what's prompting the Reserve Bank to remove the monetary stimulus it had injected early on in the pandemic. So the Reserve Bank has already hiked the cash rate 3 times now in successive moves, and we expect another 6 hikes to 2.5% by the end of the year. So the trajectory in interest rates in the economy is obviously going up. Obviously, this has the most impact on house prices and in the housing market. We do expect to see a decline in annual house prices towards the end of the year, given all that's been thrown at it. Higher mortgage rates is one thing. We've got tighter LVR restrictions, property tax changes, tweaks to the CCCFA. But given the substantial gains we've seen in house prices over the past 2 years, any decline is just going to be a modest in measurement. We see the market entering more of a state of consolidation rather than correction. I guess what's different this time around is that we have a very strong labour market, which I guess we'll touch on later. And that's really that'll support house prices for now. But I guess overall, the economy is clearly overstimulated and capacity constrained. And the question around if this will continue, all I can say is that the Reserve Bank will make sure it doesn't. It's their job to stabilise prices and bring inflation back down to target.
Thanks, Mary. Ryan or Adam, do you want to build on that at all?
I suppose, from my point of view, then obviously there's inflation growth, but what about growth in wages, and that doesn't seem to be growing as fast, and there's that disconnect then that's even causing that greater gap for those people who actually did well during the pandemic and those people that haven't. So what do we do as an industry about creating or trying to close that gap? Maybe it's a matter of savings or so forth, but there just seems to be that correlation, that disconnect between those, like I said, those who did well and those who haven't. I think that's something maybe the panel might want to answer, because I don't have a solution for it.
Thanks, Ryan. Adam.
I think these are fascinating times. I'll probably just build on sort of Mary Jo's comments that to me, I think one of the positives is that New Zealand is in a very strong position economically. When you look at sort of the level of employment, and I guess the underlying growth that's in the economy, I think that provides a solid platform for us to be able to respond to what we know will be highly uncertain in an unknown environment. And so we're going to be hit with things that we didn't necessarily expect. We already know how that feels. I'm sure that's going to continue for the next little while, but I think we've got a very solid foundation to be able to work off. So I think entirely natural that people are worried to some of Mary Jo's points, but I think we've got a really nice solid foundation to be able to be confident to respond off.
Thanks very much, Adam. We've just had a question come through from Glenn Marsh. Thanks, Glenn. We have some very high household debt levels and now have restricted liquidity with banks constrained by legislation. Do you see this combination as a potential risk to the New Zealand economy? Mary Jo.
Yeah, we do. We have built up a lot of household debt over the past years, given such, accommodative monetary conditions. But we've seen underlying demand, as Adam was saying right there, that it's very solid. We have a very strong jobs market, so there's no fear of, losing employment, and that would, exacerbate any household debt that we've accumulated. So it's just natural. And there's been good, sort of signaling from the Reserve Bank that interest rates will start to rise and have further to rise since the middle of next year. So I think with all of that, households are still in a good position, especially with how the substantial gains in house prices. They should be able to navigate themselves in this rising interest rate environment. But no doubt it will sort of challenge the resilience of household consumption and behaviour.
Thanks, Mary, and thank you for the question. So a reminder, please do feel free to pop anything into the chat function so that we can put that to the panel. Let's change tack slightly, and I'm going to engage Jarrod and Vicki. So when you go into any boardroom at the moment, the conversation certainly flows into workplace wellbeing and the labour markets. And what this report shows us is job security has risen despite the huge impact COVID had on it originally. Talk to us about the reasons behind this. And Jarrod, I might start with you first.
Kia ora. Thank you for that. So the key indicator, so this is page A13, number 4, key indicator, job security. Just been kind of reanalyzing that data. It actually aligns quite clearly with my own data. And if you look at it, we've got, for the first time, just over 50% of the workforce are feeling very secure or fully secure. 50%. So we still have a large 45-ish % of the workforce who are reasonably secure. And this kind of job insecurity is one of those things that ruminate in our head, right? So if we're in that kind of always worried or sometimes worried, that's obviously quite detrimental. But I'd kind of also flagged that the reasonably secure also means I'm reasonably insecure. And we've seen lots of, I think, hospitality, obviously tourism, and perhaps they're actually seeing, we've seen lots of business closures, for example. So we're seeing those things actually happen. And I think what this is really indicating is almost like a two-tier financial security to go with the job security. Those who have good employment, perhaps got a house, and all that debt and future mortgage increase is going on notwithstanding, but they have a certain higher level of security, and we've seen that reflected in some of those wellbeing indicators saying, actually, yes, I think you could live, we had was 80%, close to 80% saying they could live a year or so without any further income. But I think that it's this other group here, the less income one, they're going to have the mental health problems. So my data showing mental health has been increasing across the pandemic, and in particular job burnout. I've done a lot of work around job burnout. One thing I like to say to people is if you burn out from your job, just trying to tie these themes together, you're looking at 2 to 3 months to recover. How many people have 2 to 3 months of sick leave, paid leave, savings to accommodate that? And I would suggest that, the data here suggests quite a lot. They may be the ones who are less likely to lose their job, less likely to burn out. So it may be that, again, we're going to see this two-tier difference in well-being around the kind of financial background. So I think, without being crass, the winners, the grinners, that got the money and the assets and the security, things are probably looking, wow, it's volatile out there, but I can withstand it. But those who are insecure are probably just feeling like they're getting pummeled. And I do think we're going to see lots of this mental health related consequences throughout 22 and 23 as we go on. So this is great research to be looking at, because clearly we can see the financial stress, and as indicated with those growing mortgage rates, for example, we're going to see more pressure come on homeowners and those with other forms of debt. So a challenging time ahead. My insights. Kia ora.
Thanks, Jarrod. Vicki.
Thanks, Trish. And if I can just build on what Jarrod has articulated. So we do conduct research each year into employment branding, and our consistent with the themes in the fry once again. So this job security theme. Last year, over the 6-month period of the research, 87% of people indicated that they stayed in their jobs in 2021, which is incredibly high. But strongly driven by the COVID uncertainty. People were just wanting to hunker down. They, had employers who were hopefully able to look after them, depending on which industry you're in. And 54% of those people that responded said that they were actually feeling really secure in their jobs. I think that a lot of it has got to do, as you said, Trish, every boardroom's talking about it, the labour shortage. Really, the employee has the upper hand, the upper bargaining hand at the moment. And certainly it's very industry specific. So I think you do need to look at the results through an industry lens, which is what Jarrod's talking about. We know from our own experience in financial services that trying to get the right talent and capability in the current market is really tough. We are, all competing for that same pool of developers as we're wanting to build out our digital customer experiences. We're all competing for the same pool of frontline contact centre people to service our members and those sorts of things. So really the employee does have the upper hand, which gives them more security. High job security in our sector, but I'd question whether it's the same story if you were sitting in tourism or hospitality at the moment.
100%. So, there is, as we said, conversation happening in the boardroom, but what practically should leaders in our businesses be doing? Any tips and insights that you can share there?
Around retaining talent?
Retaining talent, around wellness. Yeah,
absolutely. So a couple of things. So if I can sort of build out a little bit more of the research around this. So Southern Cross runs a Healthy Futures report, which we released towards the end of 2020. So a couple of years old now, but it showed the number one issue concerning New Zealanders, consistent with what we're hearing today, is the cost of living. So access to affordable healthcare ranked highly, and it also showed that the cost is one of the biggest barriers to people accessing medical treatment, dental care, those sorts of things when they're unwell. Same research also showed that the number one threat to people's emotional wellbeing is fear that they won't have enough money to support themselves or their families. So I think you're seeing correlation between people staying in their jobs because they've got that certainty and alleviating some of these monetary fears that are coming through. And as I said in my opening comments, really consistent with how people are feeling within the wellbeing indicator of the FRI, that 52% of people saying that financial issues have adversely affected their overall wellbeing. So in terms of what New Zealand workers are expecting and what employers can do, our recent brand research, which spans back 3 years into what employees want from an employer, has seen a shift in the last 12 months. So for 2 previous years, salary and benefits were kind of how you played the game, and that was the thing that employees were looking for. But actually last year, that shifted to work-life balance, moving into the number one position, and salary and wages coming in second. It's consistent with what our internal research tells us. So we've just run some research across our employee base, asking around what benefits you value the most. Not surprisingly for us, it was health insurance. So that's great. Our people want to get the care and assurance that they need as fast as possible, but followed really closely by flexible working and access to wellbeing activities. The other thing that we've also seen growth in is in our Southern Cross membership, there's been an increasing focus on health and wellbeing. So we're continuing to grow, and we grew by 8,000 members in the last 12 months or the last financial year. And no doubt the pandemic's contributed to that, but actually it's employers looking for opportunities to build out their benefits packages that are in line with what their employees are seeking around health and wellbeing to actually secure that workforce and cement it in place. We're also seeing that trend coming through some of the free care that we're offering for our members as well, and the uptake of that. So we dialed up our care for members in recent months, offering RAISE consults. So RAISE is an employee assistance provider, but they provide support for personal work-related issues, and Care HQ, which provides virtual GP consults. So in the first 6 weeks, we had an uptake of around 5,000 consults across both of those platforms from New Zealanders. So I think my final point is that we've seen the great resignation overseas. I think this is telling us something, that actually we want some balance here. We want financial security, but we also want our employers to be caring about our well-being. And I believe that it's right that we shouldn't have to sacrifice one for the other. And I think if you want to have a competitive advantage in the current environment, we need to play a really strong role in how we curate our benefits, giving stability and assurance around well-being. But actually at the same time, I don't want to sound ignorant, because I know it's not the case that all employers can actually do that for their people. Some are really struggling due to the impacts on COVID on their business. So in the perfect world, you're gonna win by offering up that flexibility and the enhanced benefits package that gives people financial security and care around their wellbeing.
Thanks, Vicki. A powerful message for our leaders, and COVID has certainly taught us that we can be flexible when we need to. So it's about how we package that. I just want to pick up on the comment around, people not having enough money, and it's this financial preparedness theme, Adam, and I'm keen to get your thoughts from it. 2 in 5 people didn't have access to $5,000 for an unexpected event. That's a pretty shocking statistic. What are your thoughts on that? How do we change it? What can we do differently?
Great question. And we see similar sorts of stats in our own data. And I think, excitingly, this is an area where I genuinely feel like industry can have quite a significant impact. Certainly just by making it simple and easy. So at ASB, one of the things that we've found quite helpful is just by trying to break finance up into very simple concepts. So we've introduced this notion of everyday, rainy day, and one day. And so every day is all about your everyday finances, trying to make sure that you have more incoming than you've got outgoing. Rainy days, all about the unexpected, so making sure you've got a little bit set aside for the car breaking down, becoming ill, or losing your income for a period of time. And then one day is all about those bigger long-term goals, maybe buying a house, retiring, whatever those sort of, big aspirations are. And through just the use of those simple concepts, and then trying to build, easy experiences for customers to engage with those, has been very powerful. So things like a rainy day savings planner, so customers can kind of get their heads around what it means and how much they need. Save the Change has been a great example. So, if some of you may be familiar with that, that's essentially where if you might be spending $9.80 at the supermarket, and you can round it up to $10, and that 20 cents would get put into a savings account. So it sounds small, but even just in the last year, that's been about another $50 million that have gone into customer savings accounts that wouldn't have otherwise. So I think, those are just simple examples of how we can try and break it down and become more just everyday for customers. I think, another opportunity is helping those more in need. So, we've seen, we launched Support Finder about 6 months ago, which is an experience to help customers perhaps find government support that they weren't actually aware that they could tap into. And again, through that, that's put $9 million into customers' accounts that they wouldn't have otherwise got. And so I think those are just, again, any way that we can break it down, make it simple, I think that's really going to help customers be able to sort of get on top of this. And then finally, just, I think there is an opportunity in KiwiSaver as well. So to the extent that we adapted KiwiSaver into the future, a lot of customers, a lot of New Zealanders are familiar with KiwiSaver. So, I think the concept of a sidecar product sitting next to KiwiSaver would be another opportunity to just, again, make it seamless and easy for New Zealanders.
Thanks, Adam. And of course, we've got Minister Clark contemplating KiwiSaver at the moment. Ryan, do you have some thoughts in this space in terms of financial preparedness?
Yes, thanks, Trish. Some of these alarming stats that we're looking at, 2 out of 5 Kiwis don't have funds in case of emergency, and I really do believe, and what Adam was saying, the ability to be able to create an easy mechanism for savings, not only in that long term, because KiwiSaver is a great product for that, but just something that's for the short term or for those other situations, whether that is a sidecar to KiwiSaver, which is a great idea, whether that's income insurance or something like that. And, that's obviously something that individuals in their individual cases need to go and seek advice over. And this is where financial advice is so powerful. And we need to create accessibility through to that advice. Your individual situation is unique. Your family situation is unique. So go out there and get that advice for your situation. For me, I've got a family. I've got 5 children. I worry, about things like mortgage payments, inflation, all that sort of stuff, and going out there and seeking financial advice about individual situations like I have done, will give you that sort of resiliency that you need for the future, and it will give you so much more confidence, and well-being. So if I was to encourage anyone out there to do something, is to go out there and get that advice. But from an industry point of view, I think we need to be able to make that advice available, affordable, and sometimes it can be overly complicated for people. They don't always think about these things. So maybe it's inherent on us as we're selling financial product to make sure that we make sure our consumers know what they're buying, and continue to follow up with it, and to make sure that as their circumstances change, that we're aware of that.
Thanks, Ryan. From the financial preparedness point of view, we've got on the table the proposed income insurance scheme. Who would like to tackle some thoughts around that? Mary Jo.
Yeah, I think it's an interesting policy. I think if we were to put it in today's climate, maybe a targeted approach would be probably most prudent. A lot of this discussion today is saying how in aggregate, the economy is doing very well. Employment is very strong, and the labour market is at a record low. The tightness in the labour market is very tight. But when you look down underneath the covers, you've got industries doing very differently. Hospitality, as we're saying, and tourism are doing it the most tough, especially with the closed border. So maybe this income insurance, where most job losses have been concentrated in those industries. So maybe, these schemes are best suited to supporting the workers in those industries rather than, a sort of blanket a policy. But one thing I do worry about is the cost that this has on businesses, especially right now, with inflation already very, very high. It could have some, unintended consequences on businesses and the rising costs they already see now.
Thanks, Mary. Any other thoughts from the panel?
The only thing I'd add to that, Trish, is that the employee also has to bear some of the cost as well. And I think in an environment where we're talking about people feeling under financial pressure to then have further taxation obligations, I think that would be concerning for some employees. And the other thing that I slightly worry about is the industrial relations impact of it, or probably more the employment relations impact of it, and how there is the potential for employers to behave differently under the scheme based on maybe the outcomes that they were trying to achieve with their employees. So what will performance management look like in the future if there are potentially exit packages for employees that are paid for through the scheme as well? So I worry about that.
Jarrod, do you want to pick up that thread as well?
Yeah, I think, there's benefits here, right? We know that job insecurity, focusing on mental health alone, is a big driver of mental health. So I fear I'm going to lose my job. I'm having all those mental health issues. I do lose my job. They typically exacerbate, and one of those, the critical one, is likely to be I've got no money. So from the insurance side of things, hooray, I have some financial security for 6 or 7 months. So that's good. I can see that. But I do agree with the whole, employee relations side of things? Do employers now say, actually, I do need to performance manage, but it's actually far easier to lay off? I'm closing down that small division and you're both gone. And, I'll re-advertise one job later and I'll see if I can't pick up the one person I like. And I've avoided any drama with the low performer. So that actually might be, as terrible as it sounds, that might actually be a benefit for organizations, right? They might say, gosh, sometimes we struggle with performance management and this could be a benefit. It is a benefit for employees, whether it's a cost that is, especially at this time, I do agree the timing is unfortunately critical. But again, when we look at that, record low unemployment, we should remember we probably haven't seen enough of the data to see that it's a two-tier system. Winners, and there'll still be those who are struggling to get 40 hours a week guaranteed at above minimum wage. And so, fundamentally, they might benefit the most from this insurance. Kia ora.
Thanks, Jarrod. Look, I'm conscious of time. And so what I'm going to do is a final wrap, and I'm going to ask each of you to reflect on one thing and talk about what we should be looking out for and what we should be doing as an industry. So, Ryan, starting with you.
Thanks, Trish. I think we've still seen impacts, ongoing impacts of the pandemic. There's real concerns about inflation, as Mary Jo said, increasing interest rates, probably increasing house prices as well. And we've seen this substantial boost to assets, which I think we'll still continue maybe to see for a little while, even though the markets are flattening out. I think that the focus we should see going forward is on trying to create resiliency around consumer education and creation of savings. We've seen the share market grow 34%. We've seen house prices grow 34%, but then with increasing interest rates, I think we just need to be more financially literate and ready for what's coming. So that's sort of my wrap.
Thanks, Ryan. It's clear in all your comments your passion for the consumer and how we advocate and improve outcomes for them. So thank you very much for your participation today. Adam.
Thanks, Trish. Well, I think we know we're in an uncertain world. Who knows what's going to come tomorrow? But I think one of the trends that we've seen over the last few years is, I guess, New Zealanders in general just becoming more interested and aware about wellbeing and financial wellbeing and wanting to engage in the concepts. And similarly, we're seeing industry do a lot more work around financial wellbeing and wellbeing in general as well. And so, I'm really optimistic about that. Like, it's quite exciting to think that just, how much together we could make a real difference to New Zealanders and just New Zealand in general. So I think, yes, we've got a lot of challenges and a lot of unknowns ahead of us, but, if there's one thing that we can sort of focus on and control, it is our resilience and our well-being, our financial well-being, and the more that we can try and help New Zealanders move in that direction, I think the stronger we're going to be into the future. So quite optimistic, quite excited.
Good on you, and thank you so much for sharing some of the work that you're doing with us today. We look forward to keeping in touch with that, and clearly this is all about leading from the top. So thank you, Adam. Jarrod.
Yeah, I guess one of the things I do agree we're seeing more attention to well-being, and it is kind of one of those critical things we probably should have done a better job with for the last decade at least. So that's a positive. I think one of the things they're talking back about insecurity, it's important to remember that it's a perception base. So I could think, I think my job's under threat, and it isn't under threat, but that doesn't stop me ruminating and worrying and having adverse effects. So maybe one of those things, because somebody asked a question, what can leaders do? Communicate the situation in your organization. Hey, just letting you know that, yes, we've lost that contract to Russia, for example, but it's not a core part of our business. We see things ticking along as best we can. We think by the end of the year, things will be picking up. You know, stay in there, and that'll help retention as well, right? Because one of my research findings is a big driver of leaving is because I'm worried about my job prospects. So reminding now and being honest, saying actually times are terrible, and fingers crossed that if that's the way it is, you probably will keep that to yourself. But encouraging those leaders out there in secure businesses to remind their workforce that it's secure, because that'll help keep them mentally healthy and keep them staying. Kia ora.
Kia ora, Jarrod. Leaders leading is exactly what we need. So thank you for your comments, Vicki.
Thanks. I guess my reflection is the fact that we're having this conversation as an industry is just fantastic, and it raises awareness, and the research that has been done is incredibly helpful. I think from an employer perspective, we've got an amazing opportunity and role to play, again, in that leadership space. So when it comes to wellbeing, thinking about it really holistically and what we can be doing, it's not just about nutrition and physical activity. It's very much around how we can build the financial competency and capability of our workforces at the same time as well. So I think there's an amazing opportunity in there that we can continue to tap into to care for our people.
Thank you very much for joining us today, and 100% agree with you. It's really important that we come together as an industry and share our insights and perspectives. So I appreciate your time this morning. And Mary Jo, finally to you, your final comments, please.
Yeah, I guess just going back to what I said at the beginning, and that this year is just going to be very different to the past two, when we had very accommodative monetary conditions. And I guess the best way to describe or characterize this year is that we're kind of learning how to ride a bike. You know, initially you had mom or dad there to keep you from falling over and to even give you that boost. In our case, that's the fiscal and monetary support that was put into place in 2020. But now our economy is much stronger. We're in a position where we're able to ride on our own, so that policy stimulus is being withdrawn. Naturally, things might be a bit shaky at the beginning as we sort of try to navigate this environment of tighter monetary conditions, and there may even be obstacles along the way with future COVID outbreaks. But fundamentally, we have a solid economy, and we should be able to right ourselves. We have a problem of supply, not demand, and those are two different beasts, and we'd rather have a problem with supply because that's typically temporary in nature. Our terms of trade is still very favorable, so our exports are doing incredibly well on the global market, and I'd question any projections that the housing market will fall into a deep correction. But yes, some difficult months ahead, but I think we've demonstrated such great resilience and adaptability that we're in this fortunate position, and I think that'll carry us through the next 6 to 12 months.
Thanks, Mary Jo. A very easy analogy for us all to grab onto. We appreciate your time on a Friday. Look, I'd just like to thank the panel collectively. It's been a fantastic conversation, and we appreciate your insights that you've shared with us today. But to you, our audience, there's a job for you as well, and it's really important that we keep this discussion going. So please don't just log off Zoom and head away into your weekend. I want you to grab a copy of this research and think about how you can disseminate it in your organisation, talk to your leaders, pop a copy in the tea rooms if you're there, and if you're not in the office, then get it loaded on your intranet and initiate some of those discussions. We all need to champion the dialogue, and it's through that dialogue that we can bring about change. So I would encourage you to commit to that task on this Friday. And also, while you're busy doing that, how about you check out some of the fantastic events that the FSC have got coming up. Next Tuesday, the 8th of March, is International Women's Day, and we're delighted to have Hilary Barry coming and talking on the topic of Break the Bias. So that'll be a fantastic conversation. And it's followed on the 16th of March with the new CEO of the FMA, Samantha Barris. I know many of us will be interested to hear from her firsthand, so please do look out for the newsletters from the FSC to register for these events. And with that, I thank you all for coming today. I wish you best wishes for the weekend. Stay safe and well. Mā te wā. Bye for now.